In recent weeks, Nigerian billionaire businessman Mr. Femi Otedola publicly called on the Central Bank of Nigeria to raise the minimum capital requirement for banks to 1 trillion naira, following the announcement that FirstBank has met the current 500 billion naira recapitalisation threshold. According to Premium Times, Mr. Otedola argued that stronger bank capitalization would help curb the long-standing problem of Nigerian banks being run as personal estates. At face value, this argument aligns with orthodox banking theory, where capitalized banks are generally more stable, resilient, and systematically safer. However, when placed within the broader political economy of Nigerian banking and considering Mr. Otedola's recent asset disposal and growing influence in FirstBank holding company, this call raises important governance, competition, and concentration of power questions that deserves objective scrutiny. This analysis examines 1. The economics of bank recapitalization, 2. The incentives behind Mr. Otedola's position, 3. His historical business philosophy, 4. The risk of ownership concentration in Nigerian banks, 5. The need for regulatory ownership selling in Nigerian banks, then 6. Why minority shareholders must remain vigilant. Part 1. What does banks capitalization mean? Before proceeding, it is important to define some terms here. 1. Bank capitalization. Bank capital refers to the funds contributed by shareholders plus retained earnings used to absorb losses and protect depositors. It is different from deposits which belong to customers. Minimum capital requirement. This is the regulatory floor set by the Central Bank of Nigeria to ensure banks are strong enough to 1. Withstand economic shocks, 2. Lend responsibly, 3. Avoid taxpayer-funded bailouts. Personal estate banking. When critics say banks are run as personal estates, they refer to situations where 1. A dominant shareholder exerts outsized influence, 2. Board independence is weakened, 3. Lending decisions favor insiders or connected parties, then 4. Governance structure exists in form but not substance. Part 2. The case for higher bank capital. The orthodox argument. From a purely economic standpoint, raising bank capital is not inherently wrong. Potential benefits of raising bank capital includes 1. Stronger balance sheets, 2. Improved depositors' confidence, 3. Greater capacity to finance large-scale projects, then 4. Reduced systemic risk. Nigeria's banking history, particularly the 2009 banking crisis, shows how undercapitalized banks can threaten national economic stability. However, capital adequacy alone does not guarantee good governance. A well-capitalized bank can still be poorly governed if ownership is excessively concentrated on one individual. Following incentives, why timing matters in this situation. This is where objective analysis becomes essential. Key observable facts. Mr. Otedola has disposed of significant assets, including Gerugu Power shares valued at over 1 trillion naira. This disposal likely created substantial liquidity to Mr. Femi Otedola. He has emerged as a major shareholder in FirstBank holding company. He is publicly advocating for a capital threshold that many existing shareholders may struggle to meet. Economic inference. When capital requirements are raised, smaller shareholders face dilution. Institutions or individuals with large cash reserves gain advantage. Control tends to consolidate in fewer hands. This is a structural outcome, not a moral judgment. Therefore, while Mr. Otedola's argument is presented as system stabilizing, it also aligns closely with the interests of large cash-rich individuals, large cash-rich investors who can increase their ownership as others exist or are diluted. Femi Otedola's business philosophy. To assess intent, analysts often look at track records, not rhetorics or speeches. Otedola's observed business style. Across multiple sectors, energy, cement, utilities, etc., Mr. Otedola has demonstrated a pattern of 1. Strategic accumulation of influence, 2. Strong owner-driven control, 3. Decisive intervention in management, then 4. Preference for concentrated authority. This model is not illegal, nor is it uncommon among global billionaires. However, commercial firms and deposit-taking banks are fundamentally different. For banks hold public deposits. Banks enjoy regulatory protection. Banks are systematically important. As a result, what works in private industry may be dangerous in banking. Now, part 5. How FirstBank could become a personal estate in practice. Not speculation, but mechanisms. No claim is being made that FirstBank is currently anyone's personal estate. However, economic mechanisms exist through which this could occur. 1. Ownership concentration. If one shareholder controls a dominant voting bloc, board independence is weakened. Board influence. Directors may feel compelled to align with the preferences of a dominant investor. 3. Strategic lending bias. Even without direct interference, management may self-censor to align with perceived shareholder interests. Regulatory arbitrage. Weak ownership caps allow influence without outright majority ownership. This is precisely why many advanced banking systems impose ownership ceiling as per the maximum percentage a single individual or institutions will have as it concerns banks. The regulatory gap in Nigeria. Currently, Nigeria has no clear enforceable cap on how much of a bank a non-founding or founding individual or entity can own. This creates space for de facto control without formal takeover. International comparisons. In many jurisdictions, ownership is capped at 5% and 15%. Higher thresholds require explicit regulatory approval. Fit and proper tests apply continuously, not one-off. Nigeria's absence of such ceiling is a systemic vulnerability, not a personal issue. Part 7. Why shareholders must remain vigilant. This analysis is not a call for panic but for a corporate citizenship. Minority and institutional shareholders should 1. Demand transparency on ownership increases. Resist dilution without clear strategic justification. Support governance reforms. Engage regulators proactively. A bank's stability depends not only on capital but on balanced power across shareholders. And part 8. Policy recommendation. Introduce ownership ceiling. This is directed to the CBN. CBN should set a maximum shareholder limit for non-founding members directly or indirectly. Enhanced disclosure. Any shareholder crossing material threshold should trigger public disclosure and regulatory review, and then intent examine. Separate capital policy from control outcomes. Recapitalizations should not become an unintended transfer of control mechanisms. 4. Strengthen board independence. Regulators must ensure boards are accountable to institutions, not individuals. My final thought. Mr. Femi Otedola's call for stronger bank capitalization is not inherently wrong. However, good policy must be evaluated not just by intention, but by incentive and outcome. Nigeria must avoid a situation where banks are better capitalized but more concentrated, less independent and effectively controlled by a small elite, a small group of investors, or one single billionaire investor. That will replace one problem with another. True reform strengthens institutions, not individuals. Thank you.